Hi, it's Sam Ruiz here, Portfolio Specialist from T. Rowe Price. As we all know, 2020 has been an incredibly volatile year. What we've seen, we believe, is around 2 to 3 years worth of cycles or mini phases really compacted into such a short period of 6 months. And what I want to go through today is how has the Global Growth Strategy or the Global Growth Fund navigated each of these phases. We've been quite dynamic and active in the portfolio, really trying to capitalize on some of these market dislocations. And that's what's helped us really deliver quite a strong return in 2020 so far. It's hard though not to start by first looking at what markets have actually done this year. For the All Country World Index, we've recovered almost all of those initial losses. So the index in US dollar terms is down around 6%. And we look at this in US dollars because at the sector level and the index level, the fluctuation of the Australian dollar has really impacted these returns on both sides. So US dollars really helps us see how volatile markets have been. When we think about what's done well, it's really these online enabled businesses. And what Morgan Stanley actually put together is a stay-at-home index. And we can see that this group of stocks such as Netflix, stocks such as Amazon as well, are actually up around 30% year to date. And the question often gets asked, how can the market be doing so well when there's so much economic uncertainty? But what we can see here is that the market on a broad-based level has actually not done so well. There's sectors that are still realizing very deep losses, sectors such as energy and aerospace, where a lot of uncertainty still remains. And in this environment, what we've seen is a very, very narrow set of winners. So around 2/3 of the total return that's been delivered by the global index this year, it's actually only been generated by the top 10% of companies by market cap. And in this environment, what we've also seen is that growth has done incredibly well and extended its leadership over value. So with this, we want to take a look at, in an environment of COVID winners or in an environment where the stronger get stronger, how has the fund benefited from this, but how have we also looked to capitalize on this and reposition the fund to take advantage of the next market. So in 2020, we've really seen 5 clear phases, we believe. And I want to take you through each of these phases, what the markets effectively have delivered, but then also some highlights in how we were positioning throughout this period and how we've performed versus the benchmark. So what we'll see in each of these phases is the light blue line, which is representing the index, versus the dark blue line, which is representing how the fund has performed in each phase. But firstly, heading into the year, we had actually repositioned the portfolio to be a little less risky. So we'd reduced the beta to a beta of around 1, recognizing that there were some risks on the horizon, creating some uncertainty, particularly the US election, which we still know is coming before us in November. We saw the markets effectively be flat during this period, but we delivered a strong return of just a little less than 500 basis points alpha. And this was predominantly from the reporting season in this period. We had a couple of highlights such as Tesla, which was up around 120%, and Shopify, which was up more than 50% in a flat market. At this point, though, we really had no idea that this was going to be a global crisis. We headed into phase 2, which was really the very steep sell-off we saw. So markets sold off more than 30% in a very short period of time. We did better by a little bit of luck having this defensiveness in the portfolio, but also by being underweight energy and financials really helped us. So we did initially try to take any balance sheet risk out of the portfolio and aggressively look to sell any stocks where we just had no view or no insight into how they'd perform during this period. But all in all, the key work we did in this phase was really trying to assess what kind of crisis would this be. We actually went back in history and looked at the most recent 12 very big market sell-offs. Of these sell-offs, there's around 8 where the market sold off closer to 30%, and then 4 which were more dramatic, around 50% sell-offs. And we came to the conclusion that this was going to be one of the 8, so one of the more shallow sell-offs that we've seen in history. And that was really because of 3 things. There were 3 key signposts that made us a bit more optimistic. And in fact, we actually started adding back risk into the portfolio for every step lower markets went below 20%. These 3 key signposts were really China. So China was getting back to normal very quickly. They managed to effectively squash the virus quicker than people expected and got back to a normal-ish level of production pretty quickly. We also had in the healthcare side, we've never seen in history companies and countries work as collaboratively as we were seeing that they were doing to really come up with some kind of vaccine or solution to this virus. And the third one really came on the 23rd of March. And this was the unlimited stimulus that was announced by the Fed. All of these really gave us confidence that this was going to be a shorter, more shallow crisis, and we started to add back risk into the portfolio. So it was around the 23rd of March that we really entered this next phase 3, the rebound phase. So as we all know, markets rallied back very strongly, around 25% in a very short period of time. We had a lot of the riskier cyclicals stage back a rally at this point, which we didn't hold in the prior period, but we managed to keep up with markets, not delivering any alpha, but not really giving back any alpha from the prior cycles. In this market environment, we're really trying to think forward around what was the portfolio we wanted to have on the other side of this crisis. There was 2 key things we did here. Firstly, on the way out, we're looking at stocks we no longer wanted to hold. There were some stocks in staples where we just didn't believe we needed this defensiveness anymore, but also any areas of the market or any companies in particular where we didn't have a unique insight in terms of how they'd get through this crisis. So in aerospace, Boeing was a position that left the portfolio. Secondly, we were looking at how we wanted to add risk into the portfolio. And one area that stood out to us on the quality side was actually some of these quality financials. We had investors, for the most part, really go back and look at the GFC and reprice these businesses back to the same levels. But for some of these, they were either much higher quality right now or didn't have the same headwinds. So we added not necessarily to banks, but to more of these capital markets businesses, companies like Morgan Stanley, but also some alternative asset managers like KKR and Brookfield. What we were also doing at this point was, amongst our research platform, looking at what were the trends that were actually accelerating or who were the beneficiaries in this environment. And we noticed quite quickly that online in general was doing quite well. One data point that stood out to us was around e-commerce penetration. So in the 10 years from 2008 to effectively 2019, that had grown from 6 to 16%. But we'd seen that same level of growth happen in just the first 10 weeks of COVID-19. So a decade worth of growth in 10 weeks. And what we saw on the corporate side was that companies were showing this level of benefit as well. Companies like Etsy, which is an online business more specializing in homewares or arts and crafts, had seen around 100% same-store sales growth. But then even Amazon very publicly announcing that they needed to put on another 175,000 employees just to keep up with demand. So at this point, we started to realize that this was real, that there was a genuine acceleration of change here and a real way to make money from this in markets. So following that very strong rally, we entered phase 4. This was a period that markets were flat, but we actually saw stronger dispersion between who the winners and the losers were. And the market in general started to figure out that there were some true beneficiaries, namely in the online space, from this crisis. So in the prior phase, we'd done this work and really started to look around the world. Who are some of the less well-known businesses? We'd already topped up some of our stakes in Amazon and Facebook, for example, but we found some less known companies like Wix that helps with making websites, which is very, very important in an environment where people need to take their businesses online, but also Wayfair, which is a US company that sells furniture online. Before this crisis, people really doubted that an online furniture business would be successful, as people often want to touch and feel their furniture, but this was really the only way people could buy furniture in this crisis. And as we went through this period, the market really bid up companies like this, and the strategy outperformed quite meaningfully, around 500 basis points. Then came phase 5, the final phase for the 6 months. This was a period where markets did rise slightly, but up until this point, we'd had markets do quite well, but as we said earlier, a very narrow set of leaders. So in this market, investors started to think through which stocks had risen very quickly and strongly and rotating into some of the less loved parts of the market. We started to see some rotations into value in pockets, but none of these mini cycles were actually sustained. So value was starting to show a little bit of life. And in this environment, our earlier repositioning into financials particularly, which had been sold off very heavily, helped the strategy, and we outperformed coming into the end of the 6-month period. Overall, what this meant was, in a market that was slightly down for the first 6 months, the strategy delivered outperformance of 16%, and that was quite well diversified across each of these phases, given the active management throughout the period. All in all, if we summarize performance for the first 6 months, a big part of this comes initially from being on the right side of change. So holding companies that were structurally benefiting before COVID-19, but the crisis has effectively accelerated how much they've benefited. But during this period, we did get more optimistic about a recovery in markets quite early, which did help the strategy as we added back risk, and then being quite contrarian along the way. So adding to financials during that period certainly helped as the market rotated more towards value in that later part. But to give a little more context in terms of the actual attribution, there's probably two key areas. The first one on allocation. So this is a strategy that aims to be fully invested throughout time. So really in terms of allocation, it's come from as close to as possible 100% equity exposure, no free kicks from cash during that period. But also the very large majority of attribution or performance actually came from stock selection. So not our allocation to different regions or sectors. But then secondly, a key point and something that we're quite pleased about is how diversified that alpha is. As you can see across the phases, we've outperformed quite consistently throughout the different phases of the markets, but also we've outperformed across all sectors and across all regions. And a question we commonly get is, given how extreme the beneficiaries of this crisis have been, particularly in the online space, how much of that attribution has actually come from these larger cap tech stocks or the FANGs, which have done very well. And as we can see here, across each of these phases, the FANGs have only contributed a very, very minor part of that attribution. So 96% of all that outperformance has actually come from stocks other than the FANGs, which is quite diversified, but also what we're aiming to do in this strategy, trying to limit any impact one stock can have on the portfolio. While being relatively more optimistic early during the period helped performance, towards the back end of the first half, we started to see a few warning signs or amber flags, which actually led us to reduce some of the risk in the portfolio. The three key things that we think are providing uncertainty but not fully appreciated by the market at this stage. First is the US election, something where just general uncertainty about who will be successful will create a little bit of nervousness in markets. Also, Biden being successful does have a real fundamental earnings impact for US companies, as we believe that he'll roll back some of the tax stimulus from Trump. Secondly, we also have the US-China tensions, something that has started to escalate again, and we expect to continue to escalate as we get closer to the election. And then third and finally, we have the virus, something where despite some positive momentum on the vaccine front and even in therapeutics, it is something where the case growth has continued to accelerate and hasn't gone away as soon as we would have expected. So there's that continuation of the first wave in the US, but also second waves sparking up in other parts of the world. All in all, we are on a medium-term basis more optimistic. We believe that this will be the start of the next equity cycle, but believe it's prudent to take a bit of risk off the table as these uncertainties are with us right now.